Well, so after understanding a lot about demand, supply and various concepts of the subject of economics, you are all set to ready chapter number 7, that is cost analysis. Now, before we begin this chapter, I hope you all agree that cost plays a very important role for laying down the production plans. In fact, understanding about cost helps the company to look for cost reduction strategies. Today, the success of the firm depends on the one which is able to bring the maximum output in the least cost. So, in this chapter, we are going to make you understand what are the different types of cost. These are the objectives. Apart from that, students, you will study how the cost has an impact over the determination of the output, that is the production or output level, which you can also say as least cost, finding least cost output level. You will be learning a special part of cost called learning effect on cost, titled as learning cost curve, moving to factors influencing cost, and finally winding up with cost of multiple products. So these are the main objectives on which our chapter will revolve. Let's begin this chapter with meaning of cost. Here you can see that when we talk about definition of cost, it refers to aggregate of expenditure which is incurred by the producer in the process of production. So, the objective of understanding cost in economics will be purely from production angle and the valuation placed on the use of resource. Here we are trying to say that resources which are used in the production process are not free or they are scarce, and because they are scarce they have a value. Sometimes acquiring skilled labor becomes highly expensive for the firm, and to understand that we divide these costs. Once again, before we go ahead, there was a recent article in the paper which talked about the recent elections where the minimum wages have been raised. So if there's a 80% increase in the 30% increase in the wages, that's what they said. But when you talk about BPO which is a purely labor intensive industry, it is found that 80% of the cost in the industry is due to labor cost. Now imagine if the government increases the minimum wages to almost 30%, how much would be the impact in the cost of hiring labor in all labor intensive industries. So definitely paying attention on cost becomes very important for the firm, especially when they have to undertake production decisions. If acquiring resources become very expensive, then that would discourage the firms from undertaking big production targets or production plans. That takes you to the basics of what you studied in your chapter number, in chapter 6, if I am not wrong, right? Yeah, supply. So there was a determinant called cost of production. What did you learn in that chapter? That cost and supply are inversely related. So whenever the cost will go up, it will bring down the supply because it will discourage to undertake production related to those resources where the cost of production is very high. Okay, having said so much, let's go to the next slide. Here we have given you types of cost. You can see that there is a pair of cost given over here, right? Out of these, there are some which are purely economic types of cost. Now, the first thing before you start studying the types of cost is to clearly distinguish between the two different concepts of cost. One, the accountant's view about cost, and the other, economist view about cost. Now, when we talk about accountant's view of cost, you may be studying in financial accounting and subjects dealing with accounts and finance. You will see that wherever there is an entry which is made, there is a bill that can be produced. Okay, there is a voucher that can be maintained. Those costs are considered as accounting cost. Those which are accountable. Accountable means you can show in the books of account. But When we talk of economic cost, the idea which comes into the minds of student is dealing with theory. So those costs which are theoretical in nature will be considered as economic cost. Well, now if you just look at this slide, just think, which are the costs which you can categorize as economic and which are the ones which will be going into accounting? Yes? Okay. So some of you already have started answering me, where you say real cost, implicit cost, social cost, and some of you are also talking about explicit, long run, or economic cost. Okay? There are some students who are getting confused whether it should be short run or, so you are just recognizing the names of this cost and trying to assume whether they will go in accounting or in economics. But many of you are 100% sure that when we talk about total cost, average cost, historical, long run, short run, they are accounting cost. Because you might have heard, used some of this cost in your accounting and finance subjects. So it becomes easy for you to name and categorize some of this cost. Well, not to waste too much of your time, let's move to the next slide where we are going to discuss and describe each of this cost. So in the end you can finalize, or as we go with the category with each type, you can decide where should we put them in, accounting or economic. So the nature of cost, the first is money cost. Now as you see here, we are purely talking about those expenses which are actually incurred in the production process. Rent, wages and salaries, or when you talk about purchase of machinery, raw material, electricity bill, stationery. So expenses which can be maintained in the books of account, right? Money cost. But on the other hand, if you see the next paragraph, there is a word called sacrifices of factors. Now what are these sacrifices? You decide that you want to listen to this lecture. So you have taken off from your office because you have an exam tomorrow and you are going to listen to this lecture. So you have already made a sacrifice. Instead of having an option of going at the place of work and studying, you decided to listen to me or listen to these lectures because you have an exam tomorrow. So you are already making a sacrifice, which is like your real cost. Okay, real cost is that cost which cannot be measured. You cannot quantify it. Now when you go to the office, you will find sometimes there are some employees who are cribbing about their work. Oh God, I don't like this work. It's so tough. It's too many deadlines, too much of stress. Today, job stress has become a type of real cost. No company gives us any compensation for the amount of stress that we are undertaking at the place of work. Correct? It's only our health which gets affected. So if people are falling sick because of the stress level at the workplace, job stress, work stress, that's what you call, then that is a real cost issue. Now students, real cost is purely a theoretical concept. It's a psychological term. How much stress a person is taking cannot be measured. So real cost is purely a economic type, whereas money will go into accounting. Keeping this idea, we will be going further, and I think you will be able to categorize as you listen to the further slides. We move to the second type of cost, which as you see here is explicit and implicit cost. So students, when we talk about explicit cost, what are explicit cost? The word given here is actual payments. So when a company hires 100 people, then the salary or wages that it is going to pay to these 100 employees will be considered as their explicit cost. So explicit costs are all those costs which are actually incurred, making of payments, making of salaries, or any type of expenses incurred. It is nothing but the same as money cost. So the other word for explicit is money cost. Now there is a term called implicit cost. When we talk about implicit cost, here there is no corresponding payment which is given because of the work done. Now you may be wondering, if you are doing a work but you are not getting any payment, then is it really practically possible? Though there is an example discussed over here, let's take up another example. This you can have a self-study. I would say that many a times in office, you try to handle up a work assignment of your fellow colleague who is a very good friend of yours. You may not charge any money from him or her. Neither is the company going to pay you because you have handled somebody else's work as just a mutual help. Then students, that's the implicit cost you are paying. In life, we all keep paying implicit cost for someone or the other in one situation or the other. A simple example, that you have a commitment and you don't reach on time and others are waiting so that your work can be started, then they are all paying implicit cost for you. So implicit cost is the cost which you pay in terms of your time, your energy, your effort, but there is no corresponding payment for that. So implicit cost is again a purely economic term, but is it useful for decision making? Implicit cost and explicit cost. Can we say that implicit cost that is why sometimes company, when they, when we say that they are giving a very good incentive to their CEOs or managers, giving them their own vehicle, a car with a driver, that is all to bring down their implicit cost. So the amount of time that the CEO is going to spend on driving, he can use that time for some important ideas which will be required for the company. So giving the benefits to the CEOs and people at top position is the company wants to reduce their implicit cost and see to it that they are able to contribute more in generating higher turnover and revenue for the company. So when people become very specialized and intelligent and their services are considered as very valuable for the firm, then the company tries to see how much their implicit cost can be brought down. They can be given better and better type of infrastructure and facilities so that their productivity does not fall. We move to the next, third category of types of cost, private and social cost. Now students, when you see private cost, the word private stands for individual capitalist. So whatever expenses are incurred by individual firms, so whether it is, you can take up any bank, let's say when you talk about HDFC Bank, the overall cost that the bank is incurring will be reflected in their balance sheet. If you compare HDFC, a home finance bank, with HDFC, which is purely a customer bank, you will find that their balance sheets will never be the same. In fact, even if you take two identical electronic manufacturing firms, you won't find them spending the same amount of money, because each individual firm or company has its own balance sheets with its own expenses. So that is called as private cost. Second way of understanding private cost is the cost which is incurred by the firm for the decisions which are made by the firm itself. So if a company tries to bring a updated technology, or they want to change the office infrastructure, then the cost that they are going to incur in the reconstruction and rebuilding of its office will be considered private cost. But what are social cost? Now it is found that whenever there are businesses which are coming up, they definitely create some type of externalities. A simple example is of a particular flyover which is constructed in your area. Due to the construction of that flyover, there is too much of noise and air pollution. So that is a negative externality which this flyover construction project is generating in the society. But once the flyover is constructed and after the construction it is well lit with you can say street lights, then definitely that becomes a positive externality, because that particular light is focusing on your house, so you don't need to switch on the lights too often because you are getting the reflection of that light. Just an assumption, though some may look at it as negative externality also. So positive externality like discussed over here is setting up a school and garden. Today we have so many corporates and business houses who are trying to create positive externalities in the environment, like setting up schools, setting up public parks, hospitals, right? So that's what comes under social cost. Now why is the word called social cost? The social cost word will be attached, as you see over here, only when there are negative externalities generated by a business firm. That reminds us of the Bhopal gas tragedy. Now under the Bhopal gas tragedy, what happened? It was a very strong negative externality for which a lot of people lost their life. Now that is considered as social cost. After the Bhopal gas tragedy, there were reforms and there was modification in the Industrial Policy Acts, and even today environmentalists are concerned about the social cost issues, especially when it comes to business firms who are, no business firm is allowed to create negative externality in the environment. So there are many acts which withhold the company from generating negative externality. So I think this is clear, students. So positive and social cost, private and social cost. These are the two categories out of which social cost goes in economic theory, right? Now one more thing which I wanted you to remember is, if you see there was a documentary which I had observed on these medical, biomedical waste. All these injections, syringe, medicines, cotton, there are so many such medicines and things which are used in hospitals for the treatment of patients. And what companies do, what hospitals used to do is, there was a documentary on how to dispose of this this medical waste. There used to be a contract which the hospitals used to have with the pickers who would be taking up this entire medical waste and dumping it into a ground where they would hire per day, people who are very poor, who would be given the job of segregating this medical waste, like the syringe and all that, the needles and the plastic. Now, this documentary focused on the threat that these people, the rag pickers, would be having. The extremely poor people who were given some money, they would be earning. That was considered labor. The labor who was hired for segregating this medical waste was prone to the threat of a lot of infections and risk. So that was a very good documentary on social cost. And that is how today it's very important that companies, what hospitals are doing, they are bringing down their private cost, because if you want to dispose it in a particular manner, then there will be a cost involved. So to bring down that cost, they don't mind ending up with higher social cost. So private and social cost are both inversely related. In order to bring down individual expenses, companies use a shortcut route, no matter even if it is bringing a social cost. But today it's not possible because of policy makers and environmentalists who are highly active in looking across the social cost issues. The next type of cost that you see here, students, is historical and replacement cost. Now these two difference of cost are very, very important for decision making. Historical cost is the actual or original cost of a input that is purchased by the firm. And replacement cost is the current cost that will have to be incurred to purchase this input. It is found that the accountants, tax authorities, they are only taking the cost which is incurred. So when a company purchases a machine, the purchase price of the machine is already incurred. So the price at which they buy is already entered in the books of account, and then depreciation value will be taken. So now when we talk about this, okay, it becomes very difficult to understand that how historical and replacement cost can be related. So we will be learning one part of this historical and replacement cost on the with a very small example on the whiteboard. Okay, so I will explain you this one concept quickly with one very simple example on the whiteboard. So as I said, we are going to look at historical and replacement cost difference by using a very simple numerical example. Suppose we take the cost of a machine as 50,000. This is the purchase price of a machinery, and let's say the machine has a lifetime of 5 years. So using a straight line depreciation method, we will be dividing 50,000 with the lifespan of the machine. So that gives us an answer of 10,000. Now what is this 10,000? It shows that 10,000 per year the machine will depreciate by 10,000. So this is considered as a depreciation cost. So this was the historical cost or the purchase price of the machine. Now we go ahead. Now what the economist says, that this machine which was having 5 years, suppose this machine in the 4th year, it is decided that this machine has to be sold off, and the machine gets a return, it gets sold off for, let's say, 8,000, correct? So if the machine gets sold for 8,000, or let's say we can put it even 9,000, whatever you want you can take up, 8 or 9. So now what will happen is you will minus this. So if it is 8,000 or if it is 9,000, you will have to minus this, because 9,000 is at which the machine is sold from 50,000. So what happens is that if the machine has given you a return of 8,000, then you will minus from 50,000 this 8,000, correct? So how much do you come to? 42,000. Now this 42,000 has to be divided with 5. So the machine, 5 8s are 40, 5 4s are 20, right? So you get the answer 8,400. So the economists believe that the machine has not depreciated by actually 10,000, but it has actually depreciated only by 8,400. So that difference is the replacement cost. So this is how replacement cost is understood, but there is no such provision in the books of account, making replacement only a economic concept. So let's go to the slides and continue further. Okay, so after understanding about historical and replacement cost, we are moving to another very popularly spoken cost in most of our economic theories, and as you see, it is opportunity cost. Now always remember, when we talk of opportunity cost, it is the next best alternative that can be produced instead by the same factors. So if you are sitting and attending this lecture, like I said when we were discussing implicit cost, whatever you sacrifice will be considered as your opportunity cost. The time that you spend for traveling to your office is considered as your opportunity cost. Now to take a simple example, suppose if you have 5,000 rupees with you. Now that 5,000 rupees, whether you want to keep it in a fixed deposit or you want to keep it in a saving deposit. If you keep it for fixed, you will earn a higher interest, and if you keep it in saving, the interest will be lower. Now what will be the opportunity cost? If you keep it for fixed account or fixed deposit, you will sacrifice the opportunity of using the money whenever you want, because it will be fixed for a certain duration of time. So opportunity cost is whatever we lose when we use a resource for a particular task. Now the economists are saying that a business firm should always use the concept of opportunity cost whenever they are undertaking multiple projects. For example, if a company is taking a project A, then it is going to use its time and resource for completing that project, which means the time till the time that project is not completed, they will lose the opportunity of undertaking any other project, assuming that resources are scarce. So opportunity cost helps in decision making. Now there is a firm A. To give you an example, there is a firm A, and this firm A is having full plant capacity, and they are making, let's say, some type of automobile spare parts. Now the firm which is working on full capacity, okay, it is making some number of spare parts and it is supplying it in the market. Now it gets a project from some other company to make some additional or separate tools, automobile tools only, which is possible for the plant to make. But to make this alternative tools, they will have to bring down the use of their resources. So let's say the machine is being used for 100 hours. Now in 100 hours, the machine is giving you an output, okay, of let's say 10,000 rupees. So 100 hours the machine is working, giving an output of 10,000. Now when this particular company takes up an alternative project, they will have to free the hours of this machine. Matlab they have to use the machine for less time, so that instead of making the output for 10,000 rupees, that is the spare part of automobile, they will have to free the machine for making the tools. So what happens is they reduce the hours by from 100 to 70. So 30 hours of the machine are free now. These 30 hours will be used for making the tools for company B. But what will happen to the output of those automobile spare parts worth rupees 10,000? Now they won't be in a position to make an output worth rupees 10,000, because now the machine, the hours that the machine was used for making those spare parts has been brought down. Correct? So there's a 30% reduction in the use of the machine for making a particular spare part. So now they will be making a loss of, let's say, 4,000 rupees or 3,000 rupees. Now the economists are saying this is an opportunity cost. So what the company should do, when they are negotiating, they should see that this 3,000 which they are going to lose, which is the opportunity cost, should also be covered up in taking up that project. So like that, if you keep opportunity cost in your mind while making decisions, that will always help you to make much wiser decision and better in negotiation skills when you take into consideration opportunity cost of your resource. I hope you have understood this, students. Okay, so now we are moving to another type of cost which you have discussed there, fixed and variable. Now what are fixed and variable cost? Fixed cost which remain fixed over a period of time, which do not change. So there are some examples discussed over here. Alternative term used for fixed cost is overhead or indirect cost. Variable cost, the cost which directly vary with output. Examples are discussed over here. Both fixed and variable cost, their distinction becomes very popular. You will be using this when you will be studying the chapter of production. All the costs which are in the short run will be divided into fixed and variable. So we can say short run is a time in which the company incurs both fixed and variable cost. But what is long run? Long run is a time in which all the factors become variable. So there is no fixed cost.